Let's be real. Payments shouldn't be the hardest part of running a business. You set up your shop, hired employees, and stocked inventory. But then another hurdle hits accepting credit cards. Between processors, gateways, and merchant accounts, it's easy to feel overwhelmed. This video breaks down all things payment processing so you can confidently make decisions for your business and avoid unnecessary fees or tech headaches along the way. Let's start with the basics. Payment processing is a complex sequence of steps that electronically transfers funds from the customer to the merchant. So it's more than just swiping a card and watching your revenue grow. It's the authorization, verification, and settlement of transactions through electronic systems. Whether your customers pay with a credit card, debit card, or mobile wallet, their payment information has to go through the proper channels to securely complete a transaction. Before we walk through the flow, let's break down the major players in the payment process. Your payment processor is the company that handles the routing of transaction data between your customer's bank and your own. To do this, it communicates the transaction data between your business, the card networks, and the customer's bank to ensure the payment actually goes through. Think of it as the delivery driver of the payment world. It picks up the card information and gets it where it needs to go. A payment gateway is technology that captures and encrypts your customer's payment information. This tool is essential for online businesses because it acts like the digital equivalent of a card reader. It collects the data, encrypts it for security, and passes it to the processor. Some gateways are built into your e-commerce platform, while others are third-party tools you can connect. A merchant account is a special type of bank account that temporarily holds your funds after a sale before transferring the money into your business account. Not all processors require a dedicated merchant account. Some bundle this into their service, but for high volume or high risk businesses, having your own merchant account gives you more stability and greater control over terms and fees. The issuing bank is the customer's bank that issues their cards. Think Wells Fargo, Chase, and Capital One. The customer's funds are housed here before they are transferred to you. The acquiring bank is the merchant's bank, where the customer's funds are transferred to when they make a purchase. A payment service provider, or PSP, bundles multiple components, like your gateway, processor, and sometimes even the merchant account, into an all-in-one service. This is common with companies like Stripe or Square. PSPs are convenient for startups and small businesses because you can start accepting payments quickly and easily, but they may provide less flexibility or higher fees as you scale. A lot happens behind the scenes of a single transaction. Here's how the full payment process plays out from start to finish. Step 1. The customer initiates the payment. They might swipe their card, tap their phone, or enter their details online. Whichever payment method your customers choose, this jumpstarts the payment journey. Step 2. The payment information is captured. For in-person transactions, the card details are captured through your POS system. For online checkouts, they go through a payment gateway. From there, the information is encrypted and passed along to your payment processor. That encryption helps keep everything secure from potential fraud. Step 3. The payment info routes to the card network. Once your processor receives the transaction data, it forwards it to your acquiring bank. From there, the acquirer forwards the request to the correct card network, like Visa, MasterCard, Discover, or American Express, for validation and authorization. Step 4. The card network contacts the issuing bank. At this phase, your customer's card issuing bank will verify the payment. The bank checks, are there enough funds? Is the card valid? Are there any fraud alerts? Step 5. The bank makes a decision. Based on what it finds, the issuing bank approves or declines the transaction and sends that decision back down the line. Step 6. The approval flows back to your checkout. That decision's final destination is your POS or website platform. If approved, the customer will later see that their payment was successful on their bank statement after their funds were initially held following checkout. Step 7. Settlement kicks off. At the end of each day, your business should send a batch of approved transactions to your processor or acquiring bank for settlement. Your acquiring bank requests the funds from your customer's issuing bank through the card network, and then that issuing bank transfers the money back to your acquiring bank. Transaction fees are usually deducted during this phase. Step 8. The funds hit your merchant account. After settlement, the funds are deposited into your account. From there, they're transferred to your business bank account, usually within 1 to 2 business days. Customers receive a receipt as proof of purchase at checkout, while your business keeps its own detailed sales records to help maintain a secure and transparent transaction process. Each of these steps happens in seconds, and while your customer never sees it, it's what makes every transaction possible. Now that you understand how payment processing works, let's talk about why it really matters for your business. Because having a system in place isn't enough. You need one that's reliable. Let's start with the obvious. Strong security. You're handling sensitive payment information, and one breach could cost you trust, revenue, and customers. The right processor will include encryption, tokenization, and fraud detection tools to help keep every transaction safe. Speaking of safety, regulatory compliance is another critical factor. If your business accepts, stores, or transmits credit card data, you're required to follow PCI compliance standards. A reliable payment processor will help you stay compliant without needing to figure it all out yourself. Next is fraud protection. This isn't just about blocking suspicious activity. It's about real-time monitoring and proactive risk management. Fraud prevention tools help you catch problems before they happen, not after the damage is done. Payment processing should feel invisible to your customers through a completely seamless experience. Long load times, failed transactions, or clunky interfaces create friction, and friction loses sales. Smooth checkouts lead to higher conversions, plain and simple. Then there's payment flexibility. Your processor should support how your customers want to pay. In person, online, mobile, contactless, you name it. The more options you offer, the easier it is to close a sale. And finally, clear reporting. You need visibility into your transactions. That means intuitive dashboards and detailed analytics so you can track trends over time. Better data helps you make smarter decisions faster. So, what should you remember? Payment processing is how your business accepts and transfers money from customers. It involves multiple tools, a processor, a gateway, and typically a dedicated merchant account. The process seems easy on the surface, but it has a lot of moving parts behind the scenes. And most importantly, reliable processing protects your business, speeds up payments, and improves your bottom line. If you're still unsure what's right for your business, from POS systems to fraud prevention tools to business management features, we can help. At Kurv, we specialize in simplifying the payment process so you can focus on growing your business, not getting lost on the back end. To find out more about our services, click the link in the description and connect with us today. If this helped, give us a like and hit subscribe for more tips on keeping payments simple. And be sure to leave any questions in the comments below. Thanks for watching, and we'll see you next time.